Welcome back to the Abundant Culture Podcast, where business owners like you come to learn how to grow the valuation of their companies so they can sell in the future. On this show, you'll learn how to sell for top dollar and invest in profitable businesses around the country. Now, here are your hosts, Jazz and Joe.
Hey, so today I wanted to talk about something that I'm somewhat interested in. I'm a very curious person, so every now and again I just find a topic that for whatever reason interests me, and then I spend like a whole day kind of digging into it and researching it. And I do this with, most of the time it's business related, but every now and again I got into art for like a week. Photography is something that I got into just because I was bored and I got really interested in it. I'm still kind of into photography. But another thing that's business related that I just wanted to learn a little bit more about, because I just didn't know too many people who worked in the space personally, but that thing is venture capital. Now, one of the things that interests me about venture capital is you hear about all of these ridiculous returns that you're supposedly able to get by investing in venture capital funds or venture capital firms.
And what is venture capital?
So venture capital is basically, so I'll say what a venture capital fund is. So a venture capital fund, basically what it does is it goes out to high net worth individuals and institutional investors and raises a bunch of money. It pulls all that money together and then it invests that money into various different types of startups. Now, the main difference between angel investing and venture capital is that with angel investing, they're investing in what's usually called the seed round. So it may or may not have a actual product, but usually these businesses have been around for 6 months or less, and a lot of times they're probably not profitable yet, and sometimes they don't even necessarily even have revenue. So there's like really ground up. With venture capital, a lot of times they're investing, and this is just what's traditionally done. There are exceptions, but traditionally they're investing in businesses that maybe have been around for a year or two, maybe even a little bit longer. They might not necessarily be profitable yet, but they do have revenue, they do have user growth, they have a product in the market, and they have some type of product market fit, and they're just trying to figure out, how do we scale to 10 million, then 100 million, then a billion, whatever the case may be. So that's what venture capital is. It's basically just investing in startups that have some type of traction already, but aren't really at where they want to be.
So to my understanding, we're in private equity, and private equity basically goes out and buys existing businesses that have been operating and are profitable and stuff. So the only difference between private equity and venture capital is venture capital is mainly for startups, whereas private equity, they want to see at least some years, and then they also want to see profit.
Yeah, so like with a private equity firm, a lot of times they're either investing in businesses that are either already profitable or could be made profitable if you just make a couple small tweaks to the profit and loss statement, the balance sheet, and things of that nature. With venture capital, and mainly venture capital are investing in tech related companies. There are venture capital firms that invest in tons of other different things, but I think the hot topic of venture capital now is tech. And the reason why it's tech is because there's certain types of technology that are so scalable that one of the examples that I read in the book once is that this angel investor was saying that it took McDonald's like 2 decades to become a $1 billion company, whereas it took Facebook like 5 years. So the reason a lot of venture capitalists are investing in tech is because from 0 to $1 billion, that gap can be closed a lot quicker in tech companies a lot of the time than it can in other different types of industries. And that's just because of, if it's a software, you have no cost of goods related to really selling that software.
You also don't have usually overhead.
Yeah, you don't have as much overhead.
But
yeah,
it definitely wouldn't be anywhere near.
Yeah, and if you're selling hardware, it can still, take a little bit more time to scale that revenue. But just because of the nature of tech and how it's sold, a lot of times it's a lot easier to reach a $1 billion valuation with those different types of products.
But then a downside to the tech space and venture capital in tech is that although it grows really fast, it could also fall really fast too.
Yeah, so that's one of the things that was interesting to me, because when you hear about the returns that are possible in venture capital, a lot of times these guys are at least attempting to get 10x returns on their investment. So that means if you invest $1,000, they're trying to get $10,000 back by the end of the term. And that just sounds completely...
And what's like usually the term?
So the term, based on the interview that I saw, a lot of times they can be investing anywhere between 10 and 15 years is where they're looking to exit all the portfolio companies within 10 or 15 years, which that's the part that I learned later, because usually somebody says, oh, I want to look to get a 10x return on my money. Well, you really have to look into what that actually means. A 10x return when? Because if you give me, 20 years to give you a 10x return, that's not super, impossible. That's not super hard.
Invested in a Rockefeller's, like, hey, I wanna get a 10x return, and well, maybe the Rockefellers aren't a good example. I don't know, but right, like it took them. Yeah. However
like
long.
McDonald's, it took them decades.
Like it could take somebody like 300 years. Yeah. Like, that's not even relevant.
So it's a 10x return win, and that's something that I feel like is not talked about as much. Is just, you're not just looking to get a 10x return, but you're looking to get a 10x return over that period of 10 to 15 years, which a 10x return over 10 to 15 years, if I haven't done the math, but if my estimate is correct, is actually not bad, but it's not the same as getting a 10x return in 3 to 5 years. So you just have to know exactly what these people are talking about, because a 10x return in 2 to 5 years is a lot different from a 10x return in 10 to 15 years. So you just have to manage your expectations about what that timeline actually means, because you could be thinking like they got that in a year, which would be ridiculous. Not saying that it's not possible to get those type of returns in a year, but they just don't typically happen like that. Now, mind you, these are funds that are investing in startups, usually, privately owned startups. And they're not just investing in one, they're investing in several. They have, a portfolio of them. And what I was trying to just get an understanding of is like, how good is a venture capital fund's return? Like, how good is that return actually? Because a 10x return sounds, ridiculous. And if they're, doing that on a consistent basis, and, and it's actually 10x, and it's actually within the 10 to 15 years, I was like, maybe I should be, investing a little bit of money in venture capital, right. Which I think I still should, but I kind of want to do it in a different way.
But later down the line. Yeah. Legacy play.
Yeah. So with venture capital, what I was trying to figure out is, what is the return for the total fund? So I know on a specific project, you can get a 10x return, but, is every company in that portfolio, or is most of them producing a 10x return? Because if so, that's crazy. But I really wanted to figure out, okay, what are these guys actually making? Like, what does this look like on a typical normal basis? So what I just did some digging, did some research, and what I found is that, there's a high chance of failure in these startup like companies. I think they said 25 to 30% of them actually return at least 1x, which is basically just getting your money back out, the same amount of money you put in. Only 25 to 30% of them return anything, and the rest of them, which would be the other 70 to 75%, actually just totally go to zero. So whatever money you invested in those other companies, so let's say you invested in 100 companies, that means 70 to 75 of them just totally lost all of your money in those specific investments, and then 25 to 30% of those companies actually do have a return. You might just break even, and some actually produce that 10x.
And then also compare that to the individual company failure statistic rates. Like, I think I saw on the SBA website that there was like a 20% failure rate or something like that. Like, how does that compare to the individual companies?
So I think
like
The-
individual startup companies?
Yeah, I think they're probably on par with each other. So, I mean, because they're still startups, it's just they're venture-backed startups. So, I think if you're venture-backed, you might have a slightly better chance of succeeding just because you have all this capital that is backing you. But I still think that there's still a high rate of failure because you can have all the capital in the world, but if there's no product market fit, then you're not going to get any profit, and you go a long enough time without profit, you're still going to fail. So I think what venture capital companies or companies that raise venture capital, actually what they do have on their side is capital, but you can't run a successful business if all you do is just raise $1 billion. If you raise $1 billion and that doesn't convert into actual sales, then it doesn't really do, much for you in the long term. It is going to take a long time to spend that $1 billion, I would think, but you're still not necessarily running a successful company from a profit and loss or balance sheet standpoint, in my opinion.
If you own a small business and you might be looking to sell, you could run into some major issues. Forbes estimates that 9 out of 10 businesses listed never actually sell. Why? Because there's only one way to sell. You need to do these 4 steps first. So if you want to be a part of the 10% of businesses that sell for profits, we've created a free checklist for you so you can sell without those hurdles that normally hold you back. Download the free checklist by visiting www.abundantculture.co/checklist.
So
Go ahead.
Tell me about, we talked about this a little bit the other day, about what you learned in that podcast.
So there was something that I was going to get at before that, but I know what you're talking about, so make sure you remind me. So the other thing that I wanted to say is, what is the whole fund look like? So typically, even though they're looking to invest in companies that produce a 10x return, like I said, most of those companies lose money. Some of them only return back what you put in, and then some, may do 2x, 3x, 5x, and then, that maybe 1%, actually did a 10x return. But over the whole fund, what that actually usually works out to is that, based on this venture capitalist that was doing an interview, what he said, that the typical venture fund over the course of that 10 to 15 years, because of the losses and the gains actually balancing out, that they're going to typically end up netting after 10 or 15 years 2 to 3x times the money. So if they invested $100 million, then they should get $200 million as profit at 2x, or $300 million profit at 3x. So if you actually chart that out over time as a cash on cash return and break it down based on year, then I think a 2x return over 10 years is equal to basically a 20% return every single year, and I think a 3x return over the course of 10 years is a 30% return every single year, which is not bad. You're making 20 to 30% on your money, but that's before the managers and all the other fees are paid. It's going to be a little bit less after that, but all the fees and management stuff is a little bit different. So I don't know how to calculate that and be specific. But basically, based on what they were saying, even though at the end of 10 or 15 years, it is 3x, if you break it down per year, the returns are anywhere from 20 to 30% every single year, which is definitely not bad. I mean, dude, like, look at,
not bad at all.
If you have a retirement account, look at that thing. It's not doing 20 to 30% every single year. Like, you might have 1 year out of a decade where it just breaks the bank and you make like 20 something percent, but that's not, typical returns at all. So that was really cool, but that was interesting to me. And part of the reason it was very interesting to me is because you can invest in a private equity deal that's already profitable and get a similar, if not the same exact return that you would get from venture capital, which is mind-blowing, because I can invest in a portfolio of like all these different types of companies that are already profitable and make 20 to 30% of my money. 30% is a little hard if you're not growing it, but if you grow it, you can definitely achieve that 30%. Or I can invest in this venture capital fund, make the same amount of money over the same time period, but with the venture capital fund, I would actually be making all that money on the back end at the same time. So it's not like you're getting dividends. In private equity, you'll probably be getting dividends. In venture capital, you would just sell all the portfolio and basically make all this money in a lump sum, which is not bad.
In our private equity fund, we give out distributions, quarterly distributions.
Yeah.
So you're getting paid the cash flow as we go, because we're buying profitable companies.
Yeah. So the question then was, like, why would somebody like me invest in venture capital? And there's two reasons. The first reason is I think the information that you probably get from these venture capital funds is phenomenal. Imagine being one of the first people to know about Facebook and LinkedIn before almost anybody was on Facebook or LinkedIn. Like when they were at their first maybe million and a half users. I mean, right now I forgot how many users that they have, but it's hundreds of millions if I'm not mistaken. Hundreds of millions, if not billions. But imagine being part of that first million people on Facebook and knowing what's over the horizon as a small business owner. I think as a small business owner, knowing what innovation is coming before it's actually widespread is something that's super valuable, because you can implement those things into your business before other business owners even know about it. So that's part of the reason that I do want to hang out with more venture capitalists, because I just think the inside information is just super, super valuable to any small business owner. Mm-hmm. But secondly, and honestly, I can't remember if I had another reason why I would want to invest in venture capital. Oh, no. There is a second reason. I think because a lot of venture capital deals might be cutting edge, you can put money towards the future. And I think it's almost like giving to charity, but making money off of it, because, some of these, venture capital deals might be a long shot. It might not actually work out. Actually, it's most likely not going to work out. But if it does, you can say, I helped connect the whole world by investing in Facebook. Mm-hmm. Or I helped, people get to school and get to work even when they don't have a car by investing in Uber. So I think it's about impact. And I think that's what venture capital is really for.
And I feel like when you invest in venture capital or you become a venture capitalist, I feel like that's more so of a legacy play than a wealth building growth play. Because if I were a passive investor and I had to choose between like private equity and venture capital, then I would definitely go into private equity, because right now my main concern is cash flow. I need to grow. I need to build my brand. I need to build this family up, and then I can do legacy plays later when my whole family is comfortable. But when my family is not comfortable, then they're like, I shouldn't be thinking about,
cashing out in 10 to 15 years.
Right.
So like one thing you got to keep in mind is that money now is always more valuable than money later if it's the same amount of money. Mm-hmm. So that's why I think,
the time value of money.
Yeah. The private equity is, I think, the smarter investment from a monetary standpoint, but I do believe venture capital is a very, very smart long-term investment. So I think if you're one of those people that think it might be valuable to blend it together, like I eventually am, I think it's something that's worth looking at. And I wanted to share that with everybody. Now, I wanted to save what Jasmine was asking about for last, because I wanted you guys to have a good understanding of venture capital, how it works, and what the returns would be if you invested in it, and why is it different from angel investing and private equity investing. Now, one of the things that I found about venture capital, which is a little disturbing, there's a couple things that I found actually. And the reason why I believe that if Abundant Culture ever wanted to become kind of like a venture capitalist, I think we would have to change some things, because I don't necessarily agree with how everything's done. The first thing, and I'll just touch on this because it's pretty short, it's very discriminatory. If that's a word, I don't know if discriminatory is a word.
I think so. If it isn't, you understand what we're saying.
Yeah, they supposedly, this very famous venture capitalist named Chamath, I'm sorry if I mispronounced the name. I definitely can't pronounce the last name, but he's an Indian individual, and I don't know why Indian individuals just like angel investing in venture capital. It seems like a lot of them.
It's that wealthy mindset.
Yeah. But he's an Indian individual. He's the CEO of Social Capital, and I think he also invested early on in Facebook and other deals. But he's like a billionaire. Very, very cool to listen to. He sounds very down to earth for somebody who's as wealthy as he is. But he talked about how, you know, there's a lot of people who are women, who are black, who are maybe Asian or even Indian, who can go to certain venture capital firms with a very, very strong pitch, a strong idea, strong traction, and just a very, well-rounded deal, and really pitch it to these certain venture capital firms and not get funding just because of, they're a woman, they're Indian, they're black, or whatever the case may be.
Their race or gender.
Yeah, and supposedly it's a pretty big problem in Silicon Valley because, now there's firms popping up that specifically cater to minority-owned startups. Is to combat that discrimination that kind of goes on there. And it must be true because the guys that he was on the panel with actually agreed with him, and they knew a guy that they both said they would have funded, but he didn't get funding with the first firm that he went to because I think that individual is black. So that's one thing that I found that was kind of disturbing about it, and I think that's something that could be really easily fixed. It just, it just takes the work of actually, people who are like me and you getting into it to kind of shift that dynamic. But the second thing he said that was also pretty interesting to me is the fact that he's not doing venture capital the way that it's traditionally done. And the reason he's not doing that anymore is because he said that basically Silicon Valley and venture capital is basically turning into a huge Ponzi scheme. And when he said that, I was like, say what? Like, you just showed me all these great returns y'all making, and now it's a Ponzi scheme, so now I shouldn't maybe do that? Like, what's going on? So when he explained it, it makes perfect sense, but I just never thought about it. So if you heard about venture capital, you hear about rounds. Usually if somebody's going for venture capital, they're not just getting one check and they're done. They grew their business and now they're living happily ever after. That's not usually the case. They're usually raising A round, B round, C round, D round. I hear they go all the way to like E or something like that. They're raising multiple rounds of funding, and the checks are getting bigger and bigger and bigger for the companies that's raising money. And I don't think A, B, C actually means anything. It's just that's how they just name the rounds. It's like first, second, third, fourth, fifth, or whatever the case may be. But one of the things I found out is that the valuation of these companies a lot of times is loosely based on how much capital that they're able to raise. Now, in private equity, the value of your company is based on the profits and the assets within your business. It's based on, your actual company, the things that make up your company financially. In venture capital, let's say I raise $1 million today, then the fact that I raised $1 million actually increased the valuation of my company, even though I didn't invest the money yet. I didn't do anything with the capital. I don't have more profits. I don't have more assets besides the money that I just raised. But my company is automatically more valuable than it was yesterday just because I raised money.
And that's so crazy.
Yeah.
And I thought when you told me that the other day, I was thinking about the post that Gary Vee made, and he was saying, like, we're living in a world where we're praising, like, capital raising, but we're not praising what they actually do with the capital. And the whole point of raising capital is to do something with it.
Yeah. Now, here's the problem with that. Like, you might think, well, what's wrong with that? The problem with that is that basically what that's saying is instead of going out, getting customers, investing in my business, getting more equipment and assets into my business, instead of doing all that stuff and raising the valuation of my company, I can just raise $10 million. And technically speaking, I'm a $10 million company. And the way that that's actually used, because it's not just, something that's like arbitrary and just thrown out there, is actually being used. And the way that is being used is that, a venture capital firm will go out and let's say they invest $1 million into this this company, whatever company, let's call it ABC company. They invest in ABC company, $1 million into it, and technically this company is worth $1 million or more dollars. It would technically be worth more than $1 million, but I don't want to go too deep into the math. But it's worth a little over $1 million, but let's just call it $1 million. Now, this company can go off and use that capital however they want. Now, one of the things that Chamath actually talks about in the panel is that a lot of times these companies are going out and getting users for their software or their app, but they're not necessarily turning that into profit. So, you can see all these different softwares and services that are free to use up to a certain point. They can use that money to go out and get more of those free users. But if you have free users in your business, that is worth something, but it's not necessarily turning into a profitable business. So you can't put what's called a multiple of cash flow or a multiple of EBITDA on that, because it's not generating anything unless you're advertising to them. But then that's a different story.
So then how do you sell that?
Yeah, so how do you sell like your users? Because you could assign a price to that, but it will be more of like an asset sale as opposed to a sale where, I'm pulling in $100,000 of cash flow, so I can sell that cash flow for $500,000 plus whatever my assets are, whatever the case may be.
I feel like you'd be buying a lot of goodwill.
Yeah, so they're going out and they're getting users, and basically venture capital firms are putting kind of like arbitrary value to those users, and they're saying like, or we grew by 100% when technically they didn't bring in any more revenue or profit. They just grew their user base, if that makes sense.
So it's like
so they're measuring growth using things other than
actual dollars
in the door.
Vanity metrics.
They're using vanity metrics. Now what happens is they will kind of tell this to other venture capital firms and say, hey, you should invest in this thing because we grew 100% from last year. Now the next venture capital firm is going to, let's say, invest another $2 million into it. So now there's $3 million of capital raised by this startup. Now what happens is now that this startup that technically didn't produce not a lick of revenue or profit, and all they did was grow their user base, now that company is $2 million more or even more valuable than it was when the first person invested their $1 million. And they keep these venture capital rounds going all the way up to, 10 million, 50 million, however many millions. And the valuation of this company keeps growing even though it's still not profitable. Now, I'm pretty sure they'll generate some revenue off of some of those users just because, it's the law of large numbers. But this company isn't any more profitable than it was before it actually, got its first $1 million check. But the value of this company has grown 10x. Now, the first venture capital who wrote the first check, he'll say, wow, I invested in $1 million company and now it's worth 10 million or more. They'll basically go out and use that as leverage, even though they haven't returned any money to their investors. They haven't returned a dime of capital to their investors, but they'll go out and use that expected growth or that perceived growth to raise their second fund. Now, the thing where this really gets kind of wrong, in my opinion, or I won't necessarily say it's wrong, but where it gets a little weird is that in a lot of these funds, not only are they getting their percentage of profit, but they're getting what's called a management fee. So if you're managing a $10 million fund and you have a 2% management fee, then, your compensation for just managing that fund is $200,000 every single year. Now, let's say their first fund was $10 million. They wrote that $1 million check and, they were making $200,000 a year off of this fund without returning any money to their investors. But now they can say, oh, we invested in this company. Now it's worth 10 million. When we invested in it, it was only worth 1. And they can actually say, this is the IRR that we either got or are expecting to get. And they can use that to go out and raise $100 million fund. And basically off of that $100 million fund, they're going to make $2 million a year before they ever even exit an actual project. So basically, the reason why the company is growing and the fund manager is doing so well financially is because there's more money getting pumped into the machine, but the underlying business that's holding it all up isn't necessarily growing into a healthier, more profitable business. And that's why he says
it's a Ponzi scheme.
Yeah, it's basically turning into a Ponzi scheme. And what he wants to do, which is somewhat of what I kind of envision, is instead of doing all of these rounds of venture capital and basically artificially increasing the valuation of your startup, what he's doing is he'll find a startup that needs capital and he'll just write them a check for whatever full amount that they need, and then they try to grow the company organically. And instead of reaching for trying to grow 2x every single year or whatever the case may be that other venture capital firms are looking for, they're aiming to grow by 20% year over year, but they're looking to grow it in actual revenue and actual profit, which I think is a very well-rounded and healthy way to look at it, because he talks about the stress that a lot of founders are under to just artificially increase the valuation of their company, but it doesn't necessarily even help them. And what he says happens over time, a lot of times after the first guy raises his second fund, he's being compensated way more than he used to be on his first fund. He's not even really worried about your business anymore. He doesn't care whether it grows or not. He's making $2 million a year now just from you helping you raise more capital into your business. But he didn't help you become a better business owner. You just became a better capital raiser, and your business isn't necessarily better for it. It just has more money in the bank than it's actually using efficiently.
So bottom line is what I'm gathering is to make sure that you do diligence on the venture capitalists that you want to invest in your business, because they may not provide the value that they think they can.
Yeah.
So this was a lot. This was longer than our usual individual episodes, but I hope you got a lot of takeaways away from this, and I hope it helps you along in your journey. So thanks for listening, and we'll see you next time.
See ya.
If you don't diversify your investment portfolio, you could end up losing it all. But most business owners don't know how to diversify to mitigate those risks. That's why we created this resource for you. This passive investing guide is a must-have if you're planning to invest in businesses. Don't hesitate. If you have more than 25 grand liquid, then you can't afford not to take advantage of this resource. Download the 4 reasons why in 2021 you need small businesses in your portfolio now by going to www.abundantculture.co/guide.
Thank you for listening to the Abundant Culture Podcast with Jazz and Joe. If you enjoyed this episode, make sure you subscribe, then leave an honest rating and review. And remember, we're ready to buy your business. So if you're ready to sell or passively invest in other small businesses, go to abundantculture.co for more information. We publish episodes every Friday, so we'll see you next week.